So this is our presentation about the Nordic banking crisis in the 1990s. During this presentation, we'll tell you a bit about the bank crisis, the background for the bank crisis, and we'll go through some of the regulatory measures that the government used to help the countries out of the crisis. Then we'll tell a bit about the implications and the lessons learned from the Nordic bank crisis and how that has influenced regulatory measures today.
Okay, so first of all, why is this interesting? I mean, this is a crisis that happened in a little area of the world 20 years ago. Well, this is still interesting to have a look at, first of all, because the Nordic government responses to this banking crisis have become blueprints for later crises. That is, we have some instructive lessons to learn from the Nordic crisis, as these countries showed how to effectively deal with systemic banking crisis. What is notable is that some of the solutions became part of the policies for dealing with banking crisis adopted by the IMF, and later parallels can also be drawn to responses for dealing with the 2007 financial crisis. So I will start telling you a little bit about the background of this crisis. Since the 1930s, the Nordic countries have all been characterized by high growth, full employment, and financial success, but this was suddenly interrupted in the beginning of the 1990s, where Finland, Norway, and Sweden were all hit by a systemic banking crisis. So what caused this crisis? Well, it had its roots in the process of financial liberalization. This started in the 1980s, where the financial systems of Finland, Norway, and Sweden underwent major deregulation. And this financial liberalization set off a sustained lending boom, assets were rising, and consumption were rapidly increasing. This also enabled banks to strongly expand lending to new sectors and areas where they had little knowledge and where loans later proved unprofitable. At the same time, capital requirements for banks were lax, while the supervisory institutions were weak and lacked competence and resources to tackle the credit expansion. Eventually, these conditions led to a classic, yet actually unexpected boom-bust cycle in the beginning of the 1990s, with bankruptcies, falling employment, declining investments, negative GDP growth, and insolvency of the major banks that threatened the long-run stability of the Nordic economies. So from this we can actually summarize 4 causes of the crisis in the Nordic countries. First of all, there is the bad banking. We saw poor lending practices, excessive risk-taking, poor governance, and a lack of focus on risk management and internal controls. Then we also saw a market failure, especially concerning lack of transparency and poor accounting and auditing practices. Furthermore, we can highlight the weak regulatory and supervisory frameworks, especially the lax capital requirements already mentioned, and also supervision authorities that lacked authority, resources, and few on-site inspections. Finally, the fourth cause was the inadequate macro policies. It's really important for governments to be adequately prepared to deal with banks that pose a systemic risk. What we saw here during the crisis of the Nordic countries was actually governments not expecting the crisis, not ready for the crisis, and thus the responses were more experiments and well-planned responses.
So when it became obvious that there was a banking crisis in the Nordics, the Nordic governments were very early to intervening to help getting the country's banks back on track. And what was special about the Nordic banking crisis is also that the countries had some different ways of reacting regarding their regulatory measures. And here Denmark is actually the odd case out because Denmark had much stricter capital requirements on banks, and that meant that no banks were severely hit during the crisis because they had a much larger capital cushion to withstand the crisis. Norway, however, faced a severe banking crisis, and here the Norwegian government made use the tool of bridge banks, which meant that they became a shareholder of the banks during the crisis. So they set up the government bank insurance fund, which was capable of injecting capital into the distressed banks under certain loan conditions. Sweden and Finland also made use of the bridge bank tools, but they also used other regulatory measures which included bad banks and blanket guarantees. And the bad banks measure meant that that the government set up a corporate structure that could separate the bad assets from the good assets, which allowed the banks to continue its function, but only with the good assets. They also made use of blanket guarantees, where the government promises that it will cover all bank liabilities, which means that they basically promise that they will bail out the bank to ensure that trust remains in the system. So here we'll go through the government responses to the crisis in Norway. And in Norway, the crisis hit earlier than in the rest of the Nordic countries. So from 1988 to 1990, 13 of the regional medium-sized banks, they failed. But these banks didn't pose any systemic risk, and the problems were solved by merging the failed banks with larger ones. And this was financed through the industry's two guarantee funds. However, this meant that when the crisis hit in the end of the 1990s, the banking industry's funds were depleted and they were not capable of issuing deposits. And therefore, the government set up the Government Bank Insurance Fund, which functioned as a bridge bank. This meant that this fund was able to extend the loans to bank guarantee funds and to invest capital in distressed banks, and the loans were given under strict conditions. Through this fund, the government injected capital in 3 major problem banks in Norway during the early 19s, which make the government owners of these banks. Okay, so in Sweden, the government responded by taking over all the bad bank debts, and in return, banks, they had to write down losses and issue common stock to the government. Shareholders at the remaining large bank, they sold their equity to new investors, and bondholders were then protected. The government also announced that it would guarantee all bank deposits and creditors for the 114 banks in Sweden. Then there were 2 major banks, Nordbanken and Götabanken. They were granted financial support and nationalized, and here the firm's bad debts, they were transferred into asset management companies, which then sold off the assets. This meant that when distressed assets were sold later, the state gained all the proceeds, and the government also gained money by selling its shares in the nationalized bank. Then furthermore, Sweden established the Bank Support Authority, which was supposed to supervise institutions that were in need of recapitalization.
So, having outlined the responses made by the Nordic governments, let's have a look at the implications and the lessons learned. First of all, were the responses successful? We can see that after the implementation of the new regulations, creditors' confidence in the banking system were quickly restored and the banks returned to profitability. Also, comparing to other countries, we see that the fiscal costs of the resolutions were fairly small. And in the long run, we can see that the Nordic countries were actually very little affected by the latest crisis, the 2007 crisis, which suggests that there was established long-run stability and soundness of the banking sector in the Nordic countries. So what can we actually learn from this? Well, we have some key takeaways from the responses on the Nordic crisis. First of all, we see that there is a need for a prominent state involvement in the resolution process. Also, we see the importance of the financial supervisory authorities. For instance, Norway implemented an integrated supervision model that many countries has adopted later on. Furthermore, focus should be on saving the system instead of saving the individual bank. Owners should be first in line to take losses, and finally and importantly, the board and the senior management of the failing bank should not be allowed to continue.
So as we mentioned in the beginning, the government responses during the Nordic crisis has functioned as a blueprint for bank regulations later on. And there were primarily 3 tools that they used, which are bridge banks, bad banks, and blanket guarantees. So the case of bridge banks, we see this used under the Bank Recovery and Resolution Directive of the EU, where it's one of the resolution tools, so that you can transfer critical bank functions to another bank while resolution process is ongoing. Then there is the case of bad banks, and this is also a resolution mechanism used under the BRRD, and it was also used by the US government in the Emergency Economic Stabilization Act in 2008. The last tool is blanket guarantees, and during the financial crisis in 2007, 2008, we saw that governments used this policy tool to give themselves time to develop adequate policy responses while still maintaining a fairly stable financial system.
So, to conclude on the topic, we would like to highlight some of our own considerations considering the Nordic government's responses to the crisis. First of all, we see that there are some differences today which make a complete copy of the response infeasible. First of all, the complexity has increased. There is a range of financial institutions and financial instruments that are developing rapidly and now also poses systemic risk. This means that a solution that only focuses on banks is no longer sufficient. Furthermore, we can also see that the cross-border banking has increased. So in the 90s, the Nordic countries were able to choose national solutions to the banking crisis. However, today, any effective solution will require an internationally harmonized approach, which for our point of view also means that there is a need for harmonized EU regulation.
Another consideration that we have concerns the issue of using government intervention as a blueprint. So the strong involvement by the government in the banking industry, which was the case during the Nordic crisis, also highlights the problem of the too big to fail institutions, which means that the prospect for the banks that the state will take over non-performing loans can encourage banks to take excessive risk, and in this way it creates a moral hazard. Thank you for listening to our presentation about the Nordic banking crisis.